Index universal life versus variable universal life. On the same board at the same time, a side-by-side comparison. Let's check out the pros and cons to both policies. So if you've been thinking about investing into an IUL or a VUL, let's take a look at them, measure out the pros and cons, and see which one you like better. So first we're going to start with what they have in common. Both are universal life policies, which means they both have a death benefit guarantee, they both build cash value, and they both have flexible premiums. So now let's get into the pros of IUL versus the pros of a VUL policy. The pros of IUL is that it has downside protection, meaning you can go up, but you can't go down. You're not going to get obliterated. You're not going to go down to zero. The stock market goes down, you're not affected. The only thing you pay is your fees. You're not actually going to take a loss on earnings. That's because they use options. Now, also with an IUL, another pro is that it's easier to manage. It's a very hands-off approach. It's very easy to get involved in IUL. It gets invested in the index, and it pretty much just sits there. You don't have to worry about it going down. You just get to participate in it going up. So now let's move to the pros of a variable universal life. Contrastly to an index universal life, the VUL, you have a lot more choice of your sub-accounts that you get to choose. So with a VUL, it's not invested directly into an index only. It's invested into usually mutual funds. Now you, as the variable universal life holder, get to choose what mutual funds you want to invest in. So it's a lot more hands-on. Additional tax advantages. So I've talked about this in my variable universal life video. And basically what that means is because it gets dividends, you can borrow your cash value, you can use your dividend yield to hopefully pay the full amount of the interest rate on the loan, and basically be able to borrow it for free. The tax advantage, of course, being that the loaned money is not taxed. So you can borrow money, use your dividend yield to pay your interest rate, and you don't pay taxes on that borrowed money versus a withdrawal. So, okay, moving right down. Full par, so full participation. So if the index or if the stock market goes up, any money that you have in a VUL, there's no limit to how high it can go. It's going to follow, it's going to trail exactly what the stock market does. You get full participation. With the IUL, of course, you have caps, so it can't go up as high. And like I've already said, the VUL pays dividends, which is just a little bit of bonus money that companies pay to their shareholders quarterly usually. It's just free money on top of whatever you're earning. If the company doesn't profit, you don't get a dividend, but it's extra money that's thrown at you that you don't get on the IUL side, another bonus to VUL. So now let's get into the disadvantages to both. The IUL, although a very safe investment, although a lot of downside protections, not a whole lot of risks, there are participation caps. So if the stock market shoots up like crazy, you only get to go up so much. If it drops like crazy, you have complete downside protection. You don't go down. But if it shoots up, you only get to participate a little bit. So take the good with the bad. It does not pay dividends. So you only get to grow with appreciation of the market. So you only make money off of it. You only accumulate cash when the market goes up. You don't get paid a dividend on top of that. So if you're expecting consistent cash flow, you're not going to get that in the form of dividends. Now the downsides to a VUL, there's no downside protection whatsoever. You can lose 100% of your cash value. Because you have all these huge advantages, you also have a couple of pretty big disadvantages to the variable universal life. Because you have full participation, this also acts as a disadvantage. You can go up just as much as you can go down. And if you've accumulated a lot of cash, you can lose it all. It's a high risk. Going along with that, it's a very high risk stock. It's high reward, but it's high risk. So if you own a lot of VUL, you put a lot of money into it, there's a lot of risk. You can lose it all. It's a lot more difficult to manage because of the high risk aspect to it. You have to be a lot more hands-on. If you know the stock market's going to drop, you might want to take your money out of certain mutual funds that aren't doing well. You're going to have to be a little bit more advanced with this. It's not like an IUL that it can just sit there and there's not a whole lot of risk. The VUL is a ton of risk. So it's a lot more of a hands-on approach to your investing in your life insurance policy. And then of course the fees. Both policies have a good amount of fees. They both accumulate cash value, but you still have to pay different types of fees, like administration fees, otherwise known as admin fees, policy fees, stuff like that. So it's going to charge you money on both sides. Even on the IUL, if there's a 0 year, meaning that the stock market didn't go up, it went down, and you didn't actually make any money off the appreciation of the stock market or the index market, you didn't go down, you didn't lose any money off of the depreciation of the market, but you still have to pay your fees. So you're still going to lose money there. So between both policies, IUL, obviously the safer choice, but you don't participate in a high upside. VUL, high upside, also very, very low downside too. You can lose it all. So IUL versus VUL, which is better for you? Well, the IUL is really great for an entry-level investor, or even more so an older investor. If you're a little bit on the older side, say you're in your late 50s, 60s or so, and you're getting in towards your retirement age, Index Universal Life would be a great choice because there's not any risk for a downside. So the money that you put in, you're not going to lose it all. When you get a little bit older in age, you don't necessarily need a massive upside. It's a little too late for that. What you really want to do is protect your downside. You don't want to lose everything. That would be pretty bad going into retirement. You have no more income from your job, and then you lose everything out of your life insurance policy. Probably not the smartest choice. So for older investors, it's great. And then also for entry-level investors that want a more hands-off approach. They like the idea of their money building slowly over time, but they're not crazy about having to be super active, moving their money from mutual fund to mutual fund, choosing their own sub-accounts, having to be a little bit more savvy. If you're unsavvy, entry-level investor, but you know you want to start building money somewhere, an IUL is a great choice. The type of person that would want a VUL, well, a variable universal life policy is great for a more savvy investor, especially someone younger. If you're a younger guy and you're a pretty savvy investor, you know how to move your money from different sub-accounts, you know what mutual funds are probably best to invest in, maybe you're working with a financial advisor. As long as you have a long investing career ahead of you to where you can hold a high risk. If you can handle a high risk, you have a high risk tolerance, then a VUL is great because you have super high potential for earnings. If you have a good financial advisor and you're investing in safe mutual funds that generally outperform the market or even just match the market, it's not a bad policy to be a part of because you're going to take full participation in the upside. And if you do take a decrease in the downside, well, hopefully you have a long period of time to where you can stay invested in the market and then ride that roller coaster back up. If you're an older investor, you may not have the time to ride it back up, so you might want to stick to an IUL. If you're a younger investor and you have a high risk tolerance and you're a little bit more savvy, a VUL is a great choice. You have your entire investing career ahead of you to make up for your downsides and ride up the upsides. So I hope that answers some of your questions that you guys had about IUL versus VUL. Both are great policies. They're just for different types of investors. So comment down below what type of investor you are, if you have a high risk tolerance or a low risk tolerance, which policy you currently have, and which one you think others should buy. Go ahead and comment down below, and if you have any questions, let me know and I'll be sure to answer them. Until next time, my name is Thomas Harkey, and thank you for watching.